Is the US economy on the brink of a major recession? And if it is, what will that mean for home prices, stock prices, and the unemployment rate? In this video, we're gonna dive deep into these new changes that seem to be causing the economy to stutter. And we will begin with President Trump and the tariff situation, moving gradually to Warren Buffett and some of his recent shocking comments showcasing how all of this seems to be reminiscent of 2008. The first thing to understand is this. From February 19th to March 13th, a time period of 17 trading days, the S&P 500 dropped 10%. This officially classifies the stock market as being in a correction. For the first time since 2022, the market seems to be pricing in some bad times ahead. With such a sharp drop happening so quickly, many are starting to think that this is just the start and the rest of the year will prove to be the beginning of a major recession. To understand why so many believe this now, let's start with a bit of background. On November 25th, 2024, Trump won the election and announced plans to impose a 25% tariff on all imports from Canada and Mexico and an additional 10% tariff on imports from China. At the time, from a market perspective, the S&P 500 was near all-time highs. From 2020, it had rallied 74%, and from 2016, 181%. It was clear without even looking at the chart that the US economy had been doing very well for the past 15 years. People can say what they want, but unemployment was at record lows, and we have not seen a true recession since 2009. An entire generation of people grew up without ever having to live through an economic collapse. On Wall Street, it could be argued that it was the best of times. Nobody could lose, and judging by most indicators, the market was and still is in a massive bubble. By nearly every measure, including the infamous Buffett indicator, the value of stocks when compared to GDP or really any other fair value figure has surpassed every point in recent history. This massive bull run continued booming until about mid-December. It was at this point foreign governments, including Mexico, China, and Canada, began hinting at retaliation if these tariff threats were serious. You can tell from the chart that it was at this point where the market started to get jittery, unsure if this so-called trade war was actually going to happen. And from this point forward, everything in the markets began to change for the worst. On January 20th of 2025, Trump gets inaugurated, and 48 hours later, the draft executive orders for the Canada-Mexico tariffs begin circulating in the Commerce Department. Despite this, the market stays somewhat balanced because many of these actions were already priced in. The common belief on Wall Street was that Trump would use these threats and tariffs as leverage, but ultimately they weren't meant to be serious long-term options. On January 29th, 2025, he signs the tariff orders, making them law, set to take effect on February 5th. But as expected by Wall Street, on February 3rd, the president announces a 30-day pause on these tariffs. At this point, the market was genuinely uncertain about what to expect, and as the days passed, sentiment shifted. Word on the street was that the tariffs were indeed coming back, and this time it was serious. And then China also got involved, with Trump adding a blanket 10% tariff on them. On March 5th, this expectation became reality when the 30-day pause unexpired. By then, the market was already in a steep decline, sort of pricing this in. Mexico would eventually receive a temporary pause, but Canada got slapped with 25% and China with 20%. China would eventually retaliate, and now Canada and Mexico are also making retaliation threats. Now, I'm not going to spend any more time talking about this recent tariff history because it honestly gets very detailed and flips back and forth every day. Instead, let's shift topics and get into why so many believe this all points to a serious recession coming very soon. Obviously, from the chart, you can see that things have not been going well lately, and a major reason is a rapid change in philosophy. You see, there are many high-level econ people who truly believe that tariffs in the 21st century are essentially an act of war, including this guy, Warren Buffett.
How do you think tariffs will affect the economy?
I mean, tariffs are actually, we've had a lot of experience with them. They're an act of war to some degree.
Now, Warren does have a point about this war thing. This is especially true when you start seeing retaliatory tariffs. This cycle can easily throw off the entire world economy, and it's the reason why we're seeing these massive shifts in stock prices. To a lot of people and companies, a tariff might as well be an economic nuke. As these policies transition from threat to reality, the stock market is reacting, and the housing market, and eventually the job market will as well. Americans would love for everything to be made in America, including the owners of these companies who send these factories overseas. But of course, in the free market, things don't work out that way for clear reasons. Referring to Buffett again, data suggests he's been preparing for the worst in the US. For months now, there have been stories about how Berkshire is sitting on a record amount of cash. And as the S&P 500 recently dipped into corrective territory, Buffett is now investing more and more into Japan. Keep in mind, this is the same guy who said time and time again that investing in America and American businesses is the way to go, and he's now diversifying away from the S&P. But the most successful investors often cite that diversifying your portfolio among different asset classes can provide even greater protection, and one globally traded asset class has been slowly trending upwards by several metrics over the past few years, even through this stock market chaos. I am talking about the fine art market, which just saw 2 headline auctions even as the S&P was on its way into a correction. Now, I'm obviously not an art collector, but that's the point. This is another asset class for investment and likely a growing one long term. A 2023 study by Deloitte estimated the overall art and collectibles wealth was at nearly $2.2 trillion and projected it could hit almost $2.9 trillion next year, leaving room for potential upside. Luckily, diversifying a slice of your own portfolio into art is easy with Masterworks, today's sponsor. Masterworks' 450 plus offerings have had over $1 billion of invested capital from 65,000 plus investors. With previous art offerings featuring legends like Picasso and Banksy, each of Masterworks' 23 exits have been profitable, distributing back over $60 million to investors, including principal. And these are investors who didn't need millions or art expertise. While the channel can't invest, my subscribers can get specialty priority access with the link or QR code on screen or by clicking the link in the description. Now, I'm not going to bore you with more tariff philosophy, so let's move on to why so many on Wall Street are warning of this coming recession. And it all has to do with a new idea on Wall Street called pretend and delay. This is the root reason for the spiral down, and it's also why we could easily see a recession in the coming years. Pretend and delay is simple to understand. For example, if Apple produces the iPhone in America, it would likely cost $500 more. Now, I just guesstimated this figure, but it's probably around that amount when you take into account wage differences here in the US compared to Asia. This really isn't a surprise to anyone. Now, if Apple did this, the iPhone would be far less competitive in the American marketplace because it has to compete with other cell phone companies who get to make similar phones overseas for pennies on the dollar. This is where tariffs come in. You can fix this issue artificially by introducing a phone tariff, which would make these overseas phones much more expensive here in the US, making them more in line with the American-made iPhone. But here is the massive problem. Everyone in the marketplace knows that the tariff is an artificial creation held up by purely politics, and in America, politics change like the wind. Every 4 years, there's a potentially new administration, which means that Apple can invest billions into American factories, and 4 years from now, with one signature, that entire investment can evaporate overnight, because without the tariffs in place, the American factories are screwed and completely uncompetitive. Now, the CEOs of these companies aren't stupid. They know how to play the game, and it's a game of chess, not checkers. First, they pretend to go along with Trump's plan of onshoring production, but they never commit all in. You will see they will likely make vague announcements that they are building or planning to build factories over a long 4 to 20 year period. This is a political win for the administration, who can now publicly pronounce they are bringing back American manufacturing. Meanwhile, Apple understands that as tariff tensions rise and retaliatory measures kick in, the economy is likely to weaken. And when that happens, public sentiment can turn on a dime. Presidents can become deeply unpopular almost overnight. As job losses mount, so does the political pressure to roll back tariffs. Once that pressure reaches a breaking point, the policies reverse and companies can return to the status quo. That's why this strategy of pretend and delay is critical for survival. Companies like Apple would rather endure a recession and wait for tariffs to be lifted than to go all in on American manufacturing only to face a downturn and see the tariffs removed afterward, effectively wiping out the value of their massive domestic investments. By stalling and playing along, they hedge their bets. It's not ideal, but it's the only move that offers a realistic path to long-term survival. Perhaps this sounds simple, but simple things are always the hardest. In actual business, it requires the greatest art to be simple, and you're seeing it happen now with dozens of these companies cozying up to the new administration, taking on this pretend and delay strategy. So what are these companies preparing for? Well, if you listen to someone like Jeffrey Gundlach, widely known as the bond king, you'll start to understand the growing concern. Bonds tend to lead the market in single shifts in the economy, and Gundlach is sounding the alarm. He recently appeared on CNBC to discuss the looming recession, and his message was clear. The US economy isn't on the verge of getting bad, it's already in rough shape. Before I show you exactly what he said, here's the shocking prediction. Gundlach expects the Fed to start cutting interest rates by July. Now, on the surface, rate cuts might seem like good news for the economy, but history tells a different story. Look back at the last few recessions. In 2000, the Fed began cutting rates, and shortly after, the recession hit. In 2007, rate cuts came, and then came the crash. Even in 2019, the Fed started cutting ahead of what turned out to be the brief but sharp COVID recession. The pattern is clear. When the Fed starts cutting, it usually means they're already behind the curve. The damage is done, and the recession is just around the corner. So when you hear that the Fed is preparing to cut, it's not a sign of strength, it's a red flag. The underlying mechanisms of the market are already breaking down, and if history is any guide, a recession may already be baked in. Take a listen to what he said.
So I don't know if that can happen, because I think the cutting will weaken economic growth, which may lead to a counter response. It's one of the problems when you get yourself in one of these vicious circles that we've got ourselves in. But I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
Wow, higher than 50% for a recession.
Yeah, I think it's 50 to 60 is where I am. Yeah, and I don't think you're going to get a rally out of the long end of the Treasury bond market. I think that already happened. We had that Pavlovian response, and we had the 10-year down to 360, and now we're back up at about 4 1/4, and I'm not sure we're going to go below 4 again, in spite of the fact the economy may weaken.
But that is not even the worst of it. We actually could have a scenario where we not only get a recession, but we get inflation to go along with it. This is what economists call stagflation, and it's sort of like a 1-2 punch. Not only is there unemployment, but there is growing prices to go along with it. This is what happened in the United States during the 70s. We had a couple bouts with this exact issue, and it usually comes in waves. In 1970, inflation jumped to 5.8%. There was a recession, and it came back down. Then once again, it blew up to 11%, and once again, we had another recession. Finally, in round 3, it went back up to 14%. It wasn't until Paul Volcker famously pushed rates up to nearly 20%, causing 2 recessions in the process, that this problem was finally fixed. In 2022, we had inflation jump to 8%, and now people are starting to think that this is just like the 70s, where the 2022 issue is essentially just round 1 of a long fight with inflation. Take a listen to Jeff explain.
How much of a risk is stagflation? I read, one person's comment today within one news article saying that we already have a, quote, whiff of it, but it's with a small s, not a large s. Is it a real risk?
I think it is. It's certainly non-zero. I mean, the tariffs could very well be inflationary, and the inflation rate is going higher anyway because of the base effects of what's rolling off from last year. And so I think they just downgraded GDP, So we're getting closer to recession, and they just upgraded the inflation forecast, although just for this year. I do think it's kind of wishful thinking to think that somehow magically it's going to go back down to 2% in 2027. But I think that forecast is mostly hope that that's going to happen. We don't see. I mean, with the Fed saying they're going to cut interest rates and tariffs coming on, I have a hard time seeing how the inflation rate is going to settle in at 2%.
And all of this ties back to how we started the video. Tariffs. Whether tariffs are good or bad is still up for debate, but many on Wall Street and even some Federal Reserve officials believe they're inflationary. In other words, they push prices higher. This connects directly into what we discussed earlier about stagflation. If the Fed is preparing to cut rates in anticipation of a weakening economy, and at the same time the president is rolling out inflationary tariffs, you're setting the stage for stagflation. This last clip from Jeffrey Gundlach sums it up perfectly. It explains why so many people believe this policy mix is a recipe for trouble and why so many companies are bracing for a turbulent few years ahead.
I want to get your take, too. You had to figure this was really just a matter of when, not if, that the president was going to weigh in, of course, related to the Fed and interest rates, in which the president posted last night, quote, and we'll show it and I'll get your reaction to it. The Fed would be much better cutting rates as U.S. tariffs start to ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America. What's your reaction to that?
It's kind of par for the course. You know, that's kind of the type of stuff that he does relative to the Fed. But I think he's not going to make any progress with that because the word is inertia. We're not in a period of flux. I don't think he's going to be jawboned into changing his interest rates. Jay Powell should wait and see. He's going to wait and see. And so I'm glad you wrote down that word inertia because that struck me as well. And I really think that defines what the posture of the Fed is for the few months ahead.
I also thought that the op-ed from the editorial board in the Journal today was quite interesting, where they made the argument now that tariffs, quote, give the Fed an inflation foil, that Chair Powell and company can basically pin any spike in inflation from here forward on the president, not themselves, that it gives them, quote, convenient cover. Do you agree?
I don't see how you could disagree with that. I think that's right. I mean, if inflation goes up, in April, May, then it's pretty easy to say that it's tariffs. And of course, Jay Powell said pretty clearly that he thinks the reason that inflation expectations have gone up by the consumer is tariffs.
How it turns out, nobody knows, but judging from the recent changes in the market, it's pretty clear that something is off. We are likely headed into some bad times, and this will have a downstream effect in everything from housing to interest rates. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know how you feel about this tariff situation in the comments below.